So far, we've reconsidered the top 5 mutual funds found in 401k plans in light of a user-friendly investment method which has been developed for over 130 years. The takeaway being none are particularly unique. American funds, Growth Fund of America and Euro Pacific Growth Fund, the Davis New York Venture Fund, Fidelity Contra Fund, and the Vanguard 500 Index Fund all share one thing in common. They all crashed in the liquidity crisis of 2008. This is your host, George Huss, and this is the 401k Owner's Manual. So we need a process to tell us, objectively, where we are in any given market cycle. Fortunately, there have been some brilliant minds who came before us, most notably a gentleman by the name of Abraham W. Cohen, commonly referred to as A.W. He was a graduate of Harvard Law who authored a book in 1947 titled Stock Market Timing. He then founded ChartCraft Weekly Service and became the publication's first editor. ChartCraft is still around. You can find them at investorsintelligence.com. A.W. expanded on the thinking of another analyst by the name of Ernest J. Staby, who published Stock Market Trading, Point-and-Figure Investing Made Easy in 1947, which was re-released in 1949 under the title The ChartCraft Method of Point-and-Figure Trading, a Scientific Approach to the Mechanics of Stock Market Trading. Staby realized that charts in general were poor tools for identifying market tops and bottoms because at market tops, most charts look great, and at market bottoms, most charts look terrible. He was looking to fashion an indicator which would be bearish at market tops and bullish at market bottoms. The idea being such an indicator would help investors become less aggressive as the market approached high risk levels and more comfortable in taking positions when the market was washed out and the risk was in fact relatively low. In 1955, A.W. Cohen introduced the New York Stock Exchange Bullish Percent Index. The Bullish Percent Index is a percentage of stocks traded on the New York Stock Exchange which are on point-and-figure buy signals. Remember, any stock can either be on a buy signal or a sell signal. There is no middle ground. Tallying the number of stocks on a buy signal and dividing by the number of stocks in the sample, we can create a scale from 0 to 100% to objectively measure the market temperature. If 70% of stocks on the New York Stock Exchange are on a buy signal, your risk is greater than if only 10, 20, or 30% of stocks are on a buy signal. It's a supply and demand thing. If 70% of stocks are on a buy signal, it means that most everyone who wants to be in the market is already invested. Think of it this way. When a stockbroker calls a client to buy something and the client says, "Great idea, what should we sell?" At the other end of the spectrum, if the New York Stock Exchange Bullish Percent Index has fallen below the 30% threshold and is marching north once again, it means most everyone who wanted to sell has already sold. They're done. But more buyers are cautiously, quietly beginning to re-enter the market. However, this is not obvious to the public because it's not obvious to the financial media. By the time it becomes obvious to the public and the financial media, the New York Stock Exchange Bullish Percent is already on the approach to 70%. Supply and demand, fear and greed are the forces in the market which move price both generally and specifically. This has always been the case, and as long as human beings are human, it will always be the case. To quote Jesse Livermore, probably one of the most flamboyant characters Wall Street has ever seen, "Wall Street never changes. The pockets change, the suckers change, the stocks change, but Wall Street never changes because human nature never changes." If you want to see a current chart of the New York Stock Exchange Bullish Percent, here's what you can do. Click the like on our fan page and post a request there. I'll message you a private link to grab it. Until next time, I'm George Huss, and this is the 401k Owner's Manual.